Thanks, Kendall.
Thanks.
Well, thank you guys for joining us tonight. As Kendall mentioned, my name's Erik Oliver, Vice President of Channel Partnerships with Cost Segregation Authority. Been doing this for about 7 years, working with CPAs, tax advisors across the country, as well as investors, building owners, helping reduce tax liability through cost segregation and a couple of the energy credits and deductions we'll talk about today. A little bit about our company. We've been in business since 2006, completed just over 25,000 studies in all 50 states. Our reports are designed by CPAs for CPAs, which is great. That's not always the case. And so CPAs love to look at our reports because they're very easy for them to read. ResNet certified. We'll talk about what that is here in a second. We've got both CPAs and constructional engineers on our staff. Because it is a very unique niche service that we offer. We don't do tax returns at our firm. We just do these cost segregations. So for those of you who joined early, Kendall and I were talking, it really is a niche service. It's kind of, I look at your tax preparers, tax strategists, they're kind of your general practitioners. They know a little bit about a lot of different subjects, where cost segregation, we're kind of the brain surgeons, where we specialize just in this one area of depreciation. And we'll talk about why that's important here in a moment. So kind of the objectives of tonight, there's really three topics we want to talk about. The first one being 179D. That's a deduction for the construction of energy efficient commercial real estate. We'll then talk about 45L. 45L is a credit that is available for folks who are building residential units. So if you are building residential units, then you may be eligible for up to a $5,000 credit. We'll talk about who's eligible, how you qualify. And then we'll spend the majority of our time talking about cost segregation. A lot of you have probably heard about cost segregation. There's a number of podcasts and YouTube specials on cost segregation nowadays with some of the changes. But we'll talk about what it is, why it's important, how it works, how to maximize those deductions. And we'll give a couple of case studies here as well. So with that, we'll go ahead and jump into 179D. I should mention before we get started, if you guys do have questions, you can enter them in the chat. And then, like I said, we'll try to answer those at the end. If Kendall sees any that are, multiple people asking the same questions, we'll try to answer those throughout the presentation. But to get started, 179D, as I mentioned, it's a deduction for the construction of energy efficient commercial real estate. So very underutilized. I think the reason it's underutilized is the IRS used to allow it to expire. And so tax preparers would never know if this program was on or off. And until the end of the year, then the Congress would get together. It usually gets bipartisan support. The Republicans like the tax deductions. Democrats like the green energy. And so they would usually come together. But unfortunately, we never knew if the program was going to be on or off. And so the nice thing about 179D is the deduction has now been made permanent. Now, permanent, according to the IRS, is, I guess, until somebody changes their mind or until we get a new administration. But currently, it's made permanent. And what it is, it's up to a $5 deduction per square foot for the construction of energy efficient real estate. Commercial real estate. Now, you do have to have a third party come in and certify the building. There's really three major components that are being looked at. Well, there's a lot of components that are being looked at, but three major factors. One is what we call the building envelope. That's the exterior walls, the insulation in the attic, the windows. We're going to look and see if that meets or exceeds what the IRS has put forth as their standard. And if it does, you may be eligible for part of that deduction. The second thing is the mechanical, that's your heating and air. So we're going to look at the efficiency on the HVAC units, determine if it meets or exceeds qualifications the IRS has put forward. And then the third component would be the lighting. Now, there's other factors that go into this, but those are kind of the three big ticket items where we see the most movement on this. And so if your building that you're building meets or exceeds these energy thresholds, you're eligible for that up to $5 per square foot. Now, it is on a sliding scale, so it goes anywhere from $2.50 up to $5 per square foot. That does get indexed for inflation, so I think it's actually up to $5.64 here in 2024. Who's eligible for this? You do have to have basis in the property at the time of construction. That's the big thing. And so if I'm a developer and I'm building an office building and I'm going to build it to sell it to an investor, if I carry the construction loan, then I'm the one that's eligible for the deductions, not necessarily the person who buys the building. I always think of it as whoever's paying for the windows and the insulation, they're the ones who are deciding what type of windows and insulation go in the building, and they're usually the ones who are eligible for the deduction. So that's something to keep in mind. If you are a nonprofit or tax exempt entity, then you can pass this deduction on to certain government entities. And so just keep that in mind as well. So even if you are tax exempt, you may have the opportunity to pass this deduction along to other entities. As I mentioned, the nice thing, or as I didn't mention, but I'm going to mention, the nice thing about the 179D is you can go back as far as 2005. So if you've got buildings that you built or constructed that are commercial in nature, all the way back to 2005, you can take these deductions without amending your prior year's tax returns, bring those deductions forward and drop them on your current tax return. So you'll see over here on the right, the table there, any buildings that were put into service between 05 and 2020 are eligible for $1.80 per square foot. And then it goes up slightly in 2021 and 2022 due to inflation. And then 2023 is where we see the big jump. And again, it's on a sliding scale in 2023 and 2024, starting at anywhere from $2.50 of deduction all the way up to $5.65, depending on when that building goes into service. So just want to keep in mind, you do have to have a third party come in, they look at the building, they put it through the modeling software, they issue a certificate that allows you to take these deductions against your income. So great opportunities, like I said, highly underutilized in the real estate world. Some questions on the 179D. Do I have to amend my tax return? As I mentioned earlier, no, you don't. You can actually go back as far as 2005. So again, if you know anybody who's built new construction or significantly improved any existing space, they may be eligible for this deduction. What types of buildings qualify? It is commercial buildings only, and it's a little bit different definition. I know there's some confusion around what is commercial, what is residential. In the tax world, commercial is any place that's open for business. Residential would be any place where somebody lives. And so even if you have a large apartment building, that may be considered residential for tax purposes, with one exception that we'll talk about here in a minute. But for the most part, in order to be eligible for the 179D, it does have to be a commercial building. And typically it has to be over about 15,000 square feet. If it's under 15,000 square feet, it's probably not worth paying for the study, because your tax savings I would want your tax savings to be significantly more than what you're paying for the study. So we'll usually look at any asset over about 15,000 square feet. We'll run some projections before we ever engage a client and say, yes, we think this is going to qualify. And then we go ahead and do the certification from there. What tax years can I take it? As I mentioned, you go back as far as 2005. It was an all or nothing deduction in 2023 and 2024. Prior to that, 2005 through 2022, you can actually qualify for a partial amount, which is great. So maybe you don't have the best HVAC, but you've got great lighting. You may be eligible for 1/3 of the deduction. So just keep that in mind as well. All right, shifting gears now, let's talk about a similar program, but it's for the construction of energy efficient residential units. And that's the first thing, it's residential. Number two, the big distinction is it's a credit, not a deduction. So a credit, remember, comes right off the top of your tax bill. A deduction comes off of your taxable income, which hence reduces your tax bill. So this is a credit for the construction of energy efficient residential units. Now, a residential unit, according to the IRS, does have to have 4 different components: a place to eat, sleep, prepare food, and use the restroom. And if it meets that, then it's considered a residential unit. And if it was built to be energy efficient, you're eligible for a deduction anywhere from $500 up to $5,000, depending on the type of asset and a few other characteristics. And we'll get into that here in just a second. Different from the 179, the 45L, you can only go back 3 years because you do have to amend your tax return. So remember, the 45L, you could go back as far as 2005. Excuse me, the 179D, you could go back as far as 2005. The 45L, you can only go back 3 years. And it does require you to amend your tax return. But again, I can't tell you how many times we've met with large home builders across the country who have never heard about this. And we were able to go back, they build 200, 300, 400 units a year. We were able to go back, create these credits per unit for the last 3 years and take advantage of those credits. So again, if you know anybody or if you yourself are building residential units, it's something you definitely want to be aware of. Definitely talk to your tax preparer about, because there's a huge opportunity there. As I mentioned, the deduction can be anywhere from $500 up to $5,000 for 2023 and through 2032. They did extend it through 2032 with the Inflation Reduction Act. So we do know this regulation will be on the books at least through 2032, or again, until the IRS decides to change their mind. But that's the current tax law. Just like the 179D, you do have to have basis in the building at the time of construction. So if you are building buildings and you are carrying the construction loan, then you're eligible for the deduction. Versus if I go buy a brand new building that maybe a developer built, I wouldn't be eligible for the credit. It would be the developer who's eligible for that credit. And it's kind of, I got ahead of myself, but this is where it's talking about you've got to have basis in the property at the time of construction. So just keep that in mind. Very similar with the 179D as well. Here's a case study where we had 50 qualified units. Now, if those units had gone into service in 2022, they would have been eligible for a maximum credit of $2,000. So that's $2,000 per unit. So 50 units, that'd give you a $100,000 tax credit. Now, if you can't utilize this credit, it is a non-refundable credit, but you can carry it forward. So if I only have a $80,000 tax bill, but I've got a $100,000 credit, I would wipe out my $80,000 tax bill. The additional $20,000 would carry forward into the next year and would offset my first $20,000 of tax liability the next year. Had those buildings gone into service in 2023, the maximum credit was $5,000, and that would have been a $250,000 tax credit. So again, you'll see there's a big jump between 2022 and the 2023 tax year as far as what the credit could be. Can a remodeling project qualify? That's a great question. Typically, the answer is no. I have seen a couple remodeling projects qualify, but in order for it to qualify, you really have to take the residential units down to the studs, because you would have to replace the insulation and the windows typically. If you're buying a residential unit, maybe you buy a fourplex, you go in and you put in some new paint, some new appliances, maybe even a new HVAC, it's probably not going to qualify because you didn't go in and put in new insulation and new windows. So on the rare instance where it does qualify on residential units for remodeling, it's where they have gutted the place all the way down to the studs typically, put in new insulation, new windows, etc. Can I apply for this tax credit on past properties? Remember, the answer is yes, but you can only go back 3 years, and it does require an amended return. And then the nice thing is there's no maximum number of credits that you can take. Here's an interesting case study. On this building, it actually qualified for both the 179D and the 45L. So if you've got residential units that are 4 stories or greater, you can actually take advantage of both of these programs. You'll get the 45L tax credit per unit, and then you'll get a deduction per square foot on the 179D side. So in this example, we were able to create a $473,000 deduction using the 179D program. And then on the credit, we were able to create a $775,000 credit. Remember, that comes right off the top of the tax bill, dollar for dollar, credit by utilizing the 45L. So again, in rare instances, we're able to utilize both of them and create significant tax savings for the clients. All right, so shifting gears now, let's talk a little bit about cost segregation. Cost segregation really is just accelerated depreciation on your real estate assets. So oftentimes We buy a piece of real estate and it gets depreciated over either 27 and a half years or 39 years for commercial buildings. So residential units get depreciated over 27 and a half, commercial over 39. So let's just make the math easy. Let's say I buy a $275,000 single family home. I take that 275, I divide it by 27 and a half years, and essentially I'm getting a $10,000 write-off every year as an expense for the next 27 and a half years. Now, I have oversimplified that slightly. Remember, you do have to pull out the land value. Land is non-depreciable. So you always take your purchase price minus land value. That gives you your depreciable basis, and that's the number you get to start depreciating on. That's called standard straight line depreciation. That's what a lot of us do. We buy a property, we get a closing statement, we give the closing statement to our tax preparer, and they're going to input that as one asset depreciated over 27 and a half years. Cost segregation says, well, I might not own my building for 27 and a half years. I want my deductions at a faster rate. Is that possible? And the answer is yes, and that's done through an engineering-based study where we come in and identify the different pieces or different components of your building, put a value to those, and some of those components can get depreciated over a much faster useful life. For example, I'm here in an office building. This carpet here is a 5-year asset. It should not be depreciated over 27 and a half. It doesn't last 27 and a half years. These window coverings behind me, those are a 5-year asset. This parking lot out here, out this window, that's a 15-year asset. So again, we have to identify those assets, put values to them, and then depreciate them over the correct useful life. And so that's how we're able to accelerate or take those deductions at a faster rate. And a number of reasons why you'd want to do that. You've got time value of money. Inflation is a hot topic right now. You know, a dollar today is worth way more than a dollar 27 and a half years from now. So give me my deductions and let me take those at a faster rate. Now, some of you will ask, well, why doesn't my CPA do this when I buy a property? And the answer is you buy a property, you give them the closing statement. All they see on the closing statement is your purchase price. They know that you purchased 123 Main Street for $275,000. But they have no idea if there's carpet in the building, and they certainly have no idea what the value of the carpet is at the time you purchase that. And so that's where a cost segregation study comes in, just as the name implies. We come in and segregate the cost into those different buckets, which allows you to take your deductions at a much faster rate. So how do we identify what can be segregated? There's really 3 rules that we follow according to the IRC Section 38. The first is if the property or the can be removed without damage to the building or structure. So this is pretty straightforward. This window covering behind me, I can take that down without damaging the building and structure. Therefore, it's probably personal property. This carpet in here, I can rip up the carpet and hopefully the walls won't collapse. It's probably personal property. The second test is if the relationship between the asset and the equipment or machinery is so close they would be retired at the same time. Now, you guys can't see, but there's a television here in the conference room. That television is a 5-year asset. But not only is the television on the wall a 5-year asset, but there's an electrical box behind that television that runs specifically to that television. And so we can not only depreciate the TV over 5 years, but all the electrical work going back to the circuit breaker, we can associate that specific electrical work with that television, and we can depreciate that over the useful life of the television. Again, the only reason I've got a plug in the middle of that wall is specific for that television. So I want you guys to think about like an apartment building. How much of the electrical work going into an apartment building is specific for 5-year assets? Things like garbage disposal, ceiling fans, appliances. Sometimes it can be as much as 50% of the electrical work going into a multifamily building is specific for those short-term assets, and we get to allocate that to the useful life of those assets. And then the third rule is if the relationship between the asset and the nature of the business are unique. So in this case, I'll use the example of a meadery. I didn't know what a meadery was. I didn't know what mead was, but a meadery produces mead. And so we got called to do a meadery down in Phoenix, Arizona. For those of you drinkers out there, mead is fermented honey. So they make an alcoholic beverage out of fermented honey. And so we got called to do a meter read down in Phoenix, Arizona. We go down there. Of course, we go down there in August when it's 120 degrees and extremely hot. And you can imagine we go in this warehouse, they've got these 50-gallon drums of honey. Well, this honey has to be kept at a certain temperature in order for it to be easy to be worked with. If it gets too hot, it becomes very runny and it's hard to work with. If it's too cold, it gets too thick. And so they've got this cooling equipment that keeps this honey at a certain temperature. Really, it's just HVAC equipment, but normally HVAC equipment to keep you and I cool in a building, that's part of the building or part of a long-term asset. But because this HVAC was specific to their business and unique to their business to keep their honey cool, we were able to reclassify that as equipment and depreciate it over a much faster useful life. So here's some commonly segregated items. Over here on the right-hand side, we've got our personal property, 5 and 7 year assets, things like carpet, countertops, cabinets, window covering, parts of the lighting, parts of the plumbing, wall covering, flooring, removable flooring. Outside, we've got our land improvements. These are all of our parking lots, curbs, gutters, asphalt, storm drains, retaining walls. This last one's kind of interesting, trees, bushes, and shrubs. If we were doing a cost seg study on this office building, I would actually go around the building and count all the trees and bushes and shrubs. And we get weird looks when we're doing it. And people ask us, what in the world are you doing? And I'm like, these are tax deductions. These things should be depreciated over 15 years, not 39 years. And so we'll put a value to all those trees, bushes, and shrubs and depreciate them accordingly. And then everything that's left over, which is usually somewhere around 70% of the cost, falls into this long-term bucket that's either 39 years or 27 and a half years of depreciable life. That's the steel walls, the roof, doors, windows, HVAC, etc. So again, we usually segregate about 30% of a building's value falls in these first two buckets here on the right. The other 70% will fall in these long-term assets. So that's really cost segregation at the highest level. There's some additional benefits that come with cost segregation that we'll talk about. One is bonus depreciation, which some of you may be familiar with that term, but that's basically puts cost segregation on steroids. We'll talk about what it is, who it applies to, and how you can take advantage of it. Then we'll talk about catch-up depreciation. This is the ability to do cost segregation on assets that have already been placed in service. So if you've got some single-family homes that you bought 3 or 4 years ago, you never did cost segregation, you find yourself in a tax liability on your 2023 return, we still have time to get those cost seg studies done without having to amend any prior years on those assets. We'll talk about how that works. The reduction of recapture on sale. When you buy an asset, you have to pay, when you sell an asset, you pay 2 types of tax, capital gains tax and depreciation recapture. And we get asked that question all the time is, Eric, if I take all this depreciation up front, don't I just have to pay it back when I sell? And we've got an example here where I'll walk you through how that works and why that's not always the case. And then if we have time, we'll talk about partial asset dispositions and Section 179. All right, so here's a case study. This is a office/retail building purchased in 2023 for $1.3 million, 1.325 actually. That's net of land. So remember, we backed the land value out because land is non-depreciable. We went in, we identified all the short-term assets, everything from the electrical, the retaining wall, data centers, desks, the equipment, flooring, etc. And here's what we came up with. So over here on the left-hand side, we've taken our 1.3 million and we've divided it by 39 years. And if you don't do cost segregation, your depreciation would be about $33,000 a year, which is great. That's why a lot of us, again, get into real estate. I'll take a $33,000 deduction every year for the next 39 years. But again, I want my deductions at a faster rate. I'm not going to own my building for 39 years. So this blue section shows the value or shows the numbers when you utilize cost segregation. So we still have the 1.3 million, but now we've broken it up into 5, 7, and 15-year assets, with the remaining portion being this long-term assets. So in our 5-year bucket, we actually identified about $145,000 worth of 5-year assets, $13,000 worth of 7-year assets, $251,000 worth of 15-year assets, and then about 69% or 914,000 stays in this long-term bucket. Well, by finding in our 5-year bucket, we had 145,000. We take that 145, we split it up over the 5 years. If you count, there's actually 6 years here. That's because there's 2 half years on either end of this. But here's our new depreciation amount totals over here. So instead of a $18,000 deduction in year 1, remember that's a partial deduction because we only owned it for part of the year. Instead of an $18,000 deduction, I'm now getting a $56,000 deduction. In year 2, my first full year of ownership, instead of the $33,000 deduction, I'm actually getting a $97,000 deduction. So that's an increase in year 2 over $63,000, which equates to about a $25,000 tax savings. I believe we calculated that at about a 35% combined state and federal rate. But you can see what we're doing is we're front loading and taking bigger depreciation numbers in the early years. And then it's not until, and actually I think it's cut off on the screen, it's year 2039, you're actually taking a little bit less than you would have had you not done cost seg. But I'm okay with that because I've had all these years here of tax savings. And so that's what we're doing. We're front loading or taking that depreciation in the early years. So let's talk about bonus depreciation. As I mentioned before, bonus depreciation, it basically puts cost segregation on steroids. So bonus depreciation has been around for a number of years. The IRS, the government, they utilize bonus depreciation to stimulate the economy. So back in 2017 at the time, bonus depreciation was at 50%, meaning if you bought a brand new, that's a key, it had to be a brand new asset, and it had a useful life of 20 years or less, you were eligible to take 50% bonus depreciation. So what that means, I'll use a bulldozer for an example. If I buy $1 million bulldozer, and it was a brand new bulldozer, not a used bulldozer, but brand new, I bought a brand new bulldozer for $1 million, and it was 50% bonus depreciation, I would be able to write off in year 1, 500,000 or 50%. The remaining useful life of that asset, the other 50% would get spread out over the useful life of that asset. So you're taking a 50% bump in year 1, which is great. Fast forward to the end of 2017 with the Tax Cuts and Jobs Act, Donald Trump is our president. Donald Trump owns real estate, and Donald Trump was very favorable to real estate investors. And so the couple things changed. The first is they went from a 50% bonus to 100% bonus. So over here on the right-hand side, you'll see this table. Any assets placed into service between 9/27 of 17 and 12/31 of 2022 are eligible for 100% bonus. Anything put into service in 2023, it's 80%. If you buy it this year, it's 60%, and it phases out or sunsets 20% every year until 2027. That's huge. Number 2 is they added 5, actually, I think it's 6 words. They added 6 words to the tax code. Remember I said you had to buy a brand new bulldozer. Now you can actually buy a used bulldozer and take advantage of bonus. So they added the words, the equipment has to be new to you, the taxpayer. 6 words. So now a used bulldozer, it's new to me, the taxpayer, and so all of a sudden I'm eligible for bonus. So enough about bulldozers. Let's talk about how this applies to real estate. So if you buy a building in, let's say, 2022, you do a cost seg study. We identify 5, 7, and 15-year assets. Remember, it's usually about 30%. So let's say you buy $1 million building. We're going to find $300,000 of short-term assets. That $300,000 is now eligible for 100% bonus, which means you can take all 100% of those, all $300,000 in year 1. So that becomes a huge deduction in year 1. Now, if you buy that asset in 2023, you get to take 80% of that $300,000 in year 1, and the remaining 20% gets spread out over the useful life of those assets. So before we move on, I do want to add here, I know I talked about bonus depreciation phasing out. It's worth noting that there is a law, a provision, a bill, I guess it is now, in Congress that has been passed by the House. It's sitting with the Senate. It's got bipartisan support, and what they're attempting to do is to extend this 100% bonus through 2025. So if you bought properties and you're thinking about doing a cost segregation, a lot of people are extending that right now because they don't want to file their tax return until Congress gets their acts together and hopefully passes this legislation. So I hope that it passes. It has bipartisan support. We're keeping a close eye on it. Every day that it doesn't pass, I get a little bit more worried that it won't pass because we are in an election year. And as we get closer to the election, Congress typically won't pass anything, but hopefully it does get passed. We were hoping it would be passed by January 29th, which was the first day to file your 2023 taxes, but it hasn't been passed yet. So we'll just keep a close eye on it. But currently it is phasing out, but I wouldn't be surprised if this 100% bonus gets extended through 2025. All right, so let's look at that same case study, that $1.3 million building. We still have but let's apply bonus. So we still have our $145,000 worth of 5-year assets here, but you'll see we're getting, instead of spreading them out evenly over 5 years, we're getting a huge bump here in year one. Actually, it's 80% of the 145 here in year one. We're getting 80% of our 7-year assets in year one and 80% of our 15-year assets. Unfortunately, we don't get 80% of our 39-year assets because remember, in order to be eligible for bonus, the asset has to have a useful life under 20 years. But that's why a cost segregation study is so important, because if you don't do cost segregation and you treat your asset as either a 27.5-year asset or a 39-year asset, then you're no longer eligible for bonus. So that's why cost segregation has become so important, because it now creates, look at these numbers it's creating over here. This is your new depreciation amount. So in year one, you're able to offset $350,000 of income versus if you don't do cost seg, it's $18,000. Now, a lot of us will say, well, I don't need a $350,000 deduction. I only made $200,000 of income last year, so I need $200,000. Well, the $150,000 of leftover deduction, it just gets carried forward into next year. You never lose the deductions. It just gets carried forward until you utilize them completely. So again, you can see bonus depreciation, as I stated earlier, it really puts cost segregation on steroids, and it creates these massive deductions here that can really shelter quite a bit of income. All right, so let's talk about catch-up benefit. So as I mentioned earlier, catch-up benefit is really just the ability to do cost segregation on assets that have already been placed in service. So let's say you bought a building in 2015, you've been taking that standard deduction for the last, 8 years. You can now do cost segregation in the 2023 tax year. So you can actually do cost segregation today, apply it to your 2023 tax return, bring forward all that missed depreciation without amending your return. It does require an additional form. It's down here at the bottom, you'll see use form 3115. It's an ugly 9-page tax form. If you don't fill them out often, it can be a little bit tedious. The nice thing is we provide that as part of our service, that 3115. But basically that form says, hey, IRS, I've been depreciating my carpet incorrectly. I've been depreciating it over 39 years. It should have been over 5 years. And here's the difference in the numbers. We're actually checking a box on that 3115 that says we're going from an impermissible method of depreciation to a permissible method. And so again, the IRS isn't going to come tell you you're doing it wrong if you're not doing it that way, because that's just more money in their pocket. But in theory, you're actually doing your depreciation incorrectly if you don't depreciate, for example, your carpet over 5 years. So now these numbers are very small and they're actually a little bit fuzzy. So I don't expect you to be able to read these. I'll read them for you. But this isn't a case study. This is that same $1.3 million building here. But now we're showing that it went into service in 2015. And so when we did the cost seg study in 2023, we determined that they were eligible to take $437,000 of depreciation. They had only taken $218,000. And so now they're eligible for an additional $218,000. So we're catching up all that missed depreciation, dropping it on the current tax return without having to amend. So that's a great opportunity. Remember, if you guys have assets on your depreciation schedules and you find yourself with a tax liability, may be the right year for you to do cost segregation and take advantage of some of these deductions. So let's now talk about the sell of an asset. This is the question we get asked most often by tax preparers, CPAs, investors, when they say, hey, Erik, this is just a timing issue. If I take all this depreciation up front, all that means is I'm going to have a larger capital gains event when I sell my asset. Because remember, when you take depreciation, you have to reduce your depreciable basis, which means when you sell, you have a larger capital gain. So keep in mind, you pay two types of tax when you sell your asset. You pay capital gains tax and you pay depreciation and recapture. And I'm here saying, take all this depreciation up front. And the idea is you're going to take this depreciation or these deductions against your ordinary income, pay some of it back at a lower capital gains rate of 20%, or at most a recapture rate of 25%, and save the spread. And what I think I'll back into an example because it makes a little more sense. But let's say you buy a building for $1 million, you sell it 5 years later for $2 million. If you don't do cost segregation, when you go to settle up with the IRS, you're telling them that everything has doubled in value, right? I bought this office and all the stuff in it for $1 million. I'm selling this office and all the stuff in it for $2 million, and you're going to get taxed on that gain. Well, my land may have doubled in value, or my walls may have doubled in value, but certainly my dirty, nasty carpet that's 5 years old has not doubled in value. Why am I selling my stained, dirty carpet for double what I paid for it 5 years ago? Well, you shouldn't be, but you are because everything is lumped together in this one asset called building. What should happen, remember, if you recall, I've said a couple times throughout the presentation that carpet is a 5-year asset. So what is the book value of your carpet when you've owned it for 5 years? Well, it's zero. So why are you selling your carpet for double what you paid for it when the IRS is telling you you can sell it for zero and pay no tax on it? And so again, take your deduction at a high rate, pay back a portion of it at a lower rate at a future date, and save the spread. Here's an example of this. This is that same office building. There's a lot of numbers here. I don't expect you guys to fully understand this in the next 30 seconds, but let me walk you through and then we'll make sure you guys get a copy of these slides. But here's our original $1.3 million purchase. We now have sold the building for $2 million. And if I don't do cost segregation, I don't actually show the math here, but just trust me, your capital gains tax, your recapture tax, your total tax bill is $198,702. When you do cost segregation, you take this 1.3 million, you split it up. Remember, we had $145,000 worth of 5-year assets, $13,000 worth of 7-year assets, $251,000 worth of 15-year assets. Well, I've owned this building now for 7 years. So what are my 5-year assets worth after owning it for 7 years? There was zero. And you can see that here. They're fully depreciated. My 7-year assets are fully depreciated. My 15-year assets still have some book value. But when all these numbers flush out here, my new tax bill is actually $164,593. That's a difference of $34,109. Now, I will say a cost seg study on a building this size, this was that retail office building, is probably around $5,000, somewhere between $4,500 and $5,500 for the cost seg study. So in this example, they actually save upon sale $34,000, not to mention all the tax savings they've had and all that time value of money that they've been able to create by doing the cost seg study in the 7 years of ownership. So again, a lot of numbers here. If you remember anything from this slide, don't sell your dirty, nasty carpet for more than you bought it for, and then call us and we'll walk through this analysis to see if in fact there is a permanent tax savings here. This is just a summary of the different case studies. You remember we've all on the same building, just applying different rules at different times throughout the ownership of that building. We were able to save anywhere from $34,000 in taxes, $15,000 in taxes here, When we applied bonus depreciation, we saved $162,000 in taxes. And then when we did the study after owning it for a few years, we were able to save $88,000 in taxes. So again, it's not usually a matter of if you should do cost seg, it's a matter of when is the right time to maximize that tax savings. You want to use these to manage those tax brackets to make sure we're maximizing the tax savings. All right, let's talk a little bit. We're doing okay on time. Let's talk a little bit on section 179. Now, this is not to be confused with 179D that we talked about early in the presentation, but section 179 expensing allows you to expense certain business expenses up to a certain dollar amount. Now, in order to do this, it has to be personal property. And so in order for you to take advantage of 179, you have to have a cost seg study to take advantage of it because you need to know what your personal property is within your building. And so those those limits for 2023 are 1.1. 2022, it's 1.2. Now, it does phase out if you spend over $4 million, it phases out completely. So as bonus depreciation starts to go down, if in fact it does go down and Congress doesn't get their act together, don't forget you can still expense up to $1.1 million, meaning you get basically 100% bonus by expensing these under section 179. So again, something that a lot of tax preparers, CPAs, EAs, they're just not familiar with. But make sure you're keeping an eye on that because if you're doing cost segregation, you want to get as much deduction as you can in those early years. Excuse me. All right. Finally, let's talk about partial asset disposition. This is that benefit of doing cost segregation that allows you to, when you dispose of a part of your building. So I always use the roof as an example because roofs are high ticket items. They get replaced often. But when you replace the roof on your building, when you've done a cost segregation study and you know the exact value of your roof, you can pull off the remaining book value off your depreciation schedule, expense it, meaning write it off on your taxes in the given year that you dispose of it, and then you put your new roof on your depreciation schedule and start depreciating that. And by doing a cost seg study and having everything line itemed, whether it's you're replacing the cabinets, the flooring, the roof, the landscaping, the parking lot, when you have everything line itemed, it allows you to create additional expensing or in this case, partial asset dispositions where you're expensing those in the current year, pulling them off the book saying, hey, I no longer have this old parking lot, so I'm going to write it off and then start depreciating the new parking lot with the new in-service date. So again, just one of the added values of doing cost segregation. Some questions to think about on cost segregation. What types of properties are worth looking at? If you would have asked me that question 5-7 years ago before 100% bonus, I would say that the asset probably had to be over about $500,000 of depreciable basis. With 100% bonus, or even in the year we're in now, the tax year 2023 with 80% bonus, anything with a depreciable basis over about $200,000 is worth looking at. Our company will always do a free benefit analysis if you've got a property that you're interested in doing. We'll look at the property and we will give you an idea of what the expected tax savings would be before you engage us. But I would say if you've got anything on the books or if you bought anything in the last couple of years over about 250,000, let's take a look at it. Let's see if we can save some significant tax dollars. When does it make sense to do a cost segregation study? You want to use these to manage your tax bracket. So if you're in a high tax bracket and you've got real estate assets on the books, let's utilize those deductions to get us out of those higher tax brackets and into those lower tax brackets. So you want to use it to manage those deductions. And then to get that analysis, we just need a copy of a depreciation schedule, or we're going to ask a couple of questions about when you bought it, what you paid for it, et cetera. And again, most cost segregation providers out there will provide that free initial analysis. We want to make sure that you're going to have significant tax savings before we ever charge you to do a study. We've got a few minutes left. Let me just talk a little bit about the IRS audit guide. the IRS issues the audit guide. So they actually have a printed document. It's an IRS audit guide. You can go to that website there, that first bullet point. You can go read it if you're really bored. I think it's like 200 pages, but it basically tells their agents how to audit these cost segregation studies if it were to come up in an audit. Now, I don't want you guys to be afraid of audits. We've done, like I said, just over 25,000 studies. We've been involved in just over 24 audits. And so it's not something that comes up often, but if you are audited, the IRS agent will look at their cost segregation audit guide, and that's how they determine what to look for in your cost seg study. So the audit guide, we follow it to a T. As long as you're using a reputable company, you don't have anything to worry about on the audit side. The two things they always look at is, one, they look at how you've determined the land value, because that's something they're familiar with and easily for them to defend. And so they'll always look at how you've categorized your land value. And the second thing is they'll look at our engagement letter to make sure that we're not charging you a percentage of your tax savings, because they're afraid that if we do it that way, then we're going to be super aggressive in our findings, and they don't want that. And so our fees in our industry are all based on size and scope of the project, not necessarily how much money you're going to save on your taxes. But those are the two things they look at. Probably my favorite slide here. These are the different methods. There's 6 different methods that the IRS says are their preferred methods for doing cost seg. The first 2 are kind of straightforward. One is a detailed engineering approach using actual costs. So if I build a building, I've got a list of all my costs. I provide that to the cost seg provider. They break it up into the different buckets. Pretty straightforward. The second one is a detailed engineering cost estimate approach. This would be if I buy an existing building. I don't have all my costs because this carpet's been in here for a number of years. We'll come in and we'll estimate it using costing software and basically reverse engineering the building. But I want you to skip down to that last one, the rule of thumb approach. An examiner should view this approach with caution, since it lacks sufficient documentation to support the allocation of project costs. That's a direct quote from the audit guide. So this is a smart group here. My question is number 6 here, this last one, is this a preferred method or not? Well, I don't know, because they contradict themselves in the same damn sentence. It says, these are our preferred methods. And then they say, don't do it this way because you can't sufficiently document the allocation of project costs. So the reason I bring this up is there's a lot of software out there where it's kind of like a do-it-yourself cost seg, where you basically input some information. It's going to spit out a report based on the information you input. But one, there was never a site visit completed. So the IRS says in order for it to be a quality study, a site visit has to be completed, meaning we've got to go look at the property. That's usually done virtually. For some of the larger projects, we'll send somebody in person, but that's not done. And then number 2 is those software programs are so conservative because they're not following the guideline that there's so much money left on the table that usually that money, that tax savings that's left on the table is 10x what the additional fees would be to pay for an engineering-based study. So yeah, you're saving a little bit of money on the front end by not paying for an engineering-based study, but usually you're losing at least 10x that fee because the numbers are so conservative. So if you guys recall, I think I mentioned we usually segregate somewhere around 30%. On the online ones I've seen, it's anywhere from 12%. The highest one I saw was 20%. So that 10% of additional depreciation, on a $300,000 building, that's $30,000 of additional deduction. $30,000 at a 30% tax bracket, that's $9,000 of additional tax savings. So yeah, you might save $1,000 on the fee up front, but if you're leaving $9,000 on the table, that's no good. So just keep that in mind. There's a lot of great cost seg providers out there, but I would always go with an engineering-based study simply because you're going to get better results and you're able to defend that in an IRS audit guide. Here's the last slide. I just want to point out number 3 here. If you remember in those look back studies that we talked about where you've owned the property for some time and now you're doing cost seg in the given year, the IRS has now stated in their new audit guide that a schedule of assets should be provided. And it should, as it says, when a taxpayer reallocates the cost of assets already on the books, a quality report identifies those assets and includes depreciation records from both before and after the allocation. And so this is that 3115 form. Not everybody does that in our industry, but now the IRS is saying that in order for it to be considered a quality study, it should have a copy of that 3115 and what they call a 481A adjustment, where we calculate the depreciation that you've taken versus the depreciation that you were eligible for. And here's the difference in those numbers. So I think that's it. So with that, I do want to just state, we're going to answer questions here in a second, but my contact information is there. Should you guys have any questions, don't hesitate to use this as a resource. We've also included a link to the protectwealth.com/cost seg. So if you guys have any assets that you want us to look at, please go to that website, input the information. It sends me a direct email, and we can get our team to jump on it. We can usually turn those analyses around in about 24 to 48 hours. As I mentioned before, you guys still have time to get these in before the 2023 tax filing deadline of April 15th. And certainly if you're going to extend, we have until October to get these done. So please don't hesitate to reach out. Use this as a resource, guys. We don't charge by the hour. So please don't hesitate to give us a call. We're happy to help. I don't know anything about earned business income or child tax credits. I'm sure Kendall's got a resource for that. But if you've got real estate questions or real estate tax questions, we're happy to help. I actually noticed here, and I apologize, looks like there's a typo in my email address. It's eric@costsegaauthority.com. So just make that note. I'll get that corrected before we send these slides out, but there's just a typo there. So again, visit that website if you guys have any property. With that, Kendall, we'll go ahead and open it up to questions. I think there's a couple there in the Q&A, and then if you've got
Yeah, you want me to read them out, or you're welcome
I
to
can just go through them. I'll just go ahead and plow through these here. So the first question, can we do cost segregation for long-term rentals for tax purposes? Absolutely. You just want to keep in mind, long-term rentals, typically for most folks, that deduction that we create is going to be considered a passive deduction. And you got to make sure you have passive income to offset that passive deduction. So I'll give you an example. I'm a W-2 employee. My wife is also a W-2 employee. We have a couple rental properties that are long-term rentals. When we do our cost seg studies on our long-term rentals, those deductions can't be used to offset my W-2 income, but they can be used to offset our rental income. So the way around that is if either you or your spouse becomes a real estate professional. In order to become a real estate professional, you have to spend 750 hours a year doing real estate. That's about 14 and a half hours a week. That's the easier test. The harder test is you have to spend 51% of your working time managing those properties. 51% of your working time doing real estate, not necessarily managing those properties, but you've got to be spending 51% of your working time. So if I have a 40-hour-a-week job here at Cost Seg Authority, I really have to do 41 hours a week in order to qualify as a real estate professional. But if you can qualify for a real estate professional saying that, hey, I do real estate for a living, now my depreciation or my cost seg deductions can now be used to offset me and my spouse's income. So you'll see a lot of times if you've got, for example, a doctor or a dentist who is a high W-2 earner, they oftentimes will try and qualify their spouse to become real estate professionals so that they can buy assets, use the depreciation from those assets to offset their high W-2 income. So again, talk to your tax preparer, see if that's something that you may qualify. Second question, does a cost seg benefit only for new construction? What if I buy an older but expensive home and make improvements? So great question. No, cost segregation works not only on brand new assets, it works on buildings that were built in the 1800s. You could buy a building that was built in the 1800s, and as long as you paid over $200,000 for that building, it's probably going to make sense to do cost segregation. So the answer is yes. As far as improvements go, you don't necessarily have to make improvements in order for it to make sense on a cost segregation side. So when you bought that building, even if it has really old, dirty carpet, that carpet, we start the depreciable life of that carpet the day you buy it, the day it goes into service. And so, yeah, you don't have to go in and replace the carpet, even if it's old, even if the carpet's been used for 10 years and carpet's a 5-year asset, we still get to now depreciate that carpet, again, starting the clock over at 5 years on that. So, yeah. Deduction. Does this mean the tax credit or deductible expense? So a deduction is a deductible expense that it's a non-cash expense. So depreciation is a non-cash expense that comes off of your taxable income. That's different than a credit. A credit, if you get a $10,000 deduction, if I make $100,000 of income, instead of paying tax on $100,000, I now only pay tax on $90,000 because I've got this $10,000 deduction or this depreciation expense. If I have a $10,000 tax credit, I calculate my taxes. Let's say I owe $40,000 in taxes. This credit comes right off my tax bill. So a $10,000 tax credit is worth more than a $10,000 tax deduction. Just keep that in mind, but that was a great question. Do assisted living facilities qualify as residential? That's a great question. The answer is yes and no. It depends on the type and how they're structured. So remember, for the 45L, in order for it to be a residential unit, it must have a place to eat, sleep, and prepare food. And that's the one that usually we get caught up on with assisted living because they don't always have kitchens or dinettes within the unit. Sometimes there's a common kitchen. And so the answer is maybe, but we'd have to look at it. But yes, they can be considered as residential if they've got the ability to cook or prepare food within those individual units. Cost seg, is it dependent upon the overall value of the property? Is there a cap? There is no cap. It's not dependent on the value of the property. It's dependent upon your purchase price. So if you do cost segregation studies, if you do a cost seg study on a building that you bought in 2005, let's say you bought it in 2005 for $300,000 and it's now worth $600,000, and you do the cost seg study this year, we're still going to use your original $300,000 purchase price. So it's not done on the value of the property the day you do the cost seg study. It's your depreciation is determined based on the purchase price of the asset. What if I'm buying a new building that is a triple net lease, and at what purchase point does it make sense? So triple net is fine. Even if the tenant pays for some of the improvements inside, some of those improvements, depending on the size and scope of them, are going to get left with the building. And so we do Starbucks and Wendy's and Walgreens. We do a lot of triple net lease cost seg studies. And usually, like I said, in order for it to make sense, the building has to be over about $200,000 of basis. And it's worth looking at if it is. So hopefully that answers that. What about a fence structure in a residence? As a rental property, does it depreciate over a 7-year period? A fence would actually depreciate over a 15-year period as a land improvement. And so fencing is a land improvement. That's a 15-year asset, but it is eligible for bonus depreciation. And so as long as you know the value of that, you can take advantage of the bonus depreciation. If you need to recapture the deduction, then what is the benefit of cost segregation? Yeah, you get to take it early, but you have to pay it back. So yes, you do pay it back, but you're taking it early. So if I'm in a 35% tax bracket, I'm taking my deduction today at 35%, paying back some of it, depending upon how long I've owned it. I'm paying back some of it at a 20% capital gains rate, or at most a 25% recapture rate, and saving the spread. And that's the example I gave where we sold the building, where we created the $34,000 tax savings. So again, take your deduction at a high rate. So we're playing a game of rate arbitrage. We're taking our deduction at a high rate, paying back some of it, not all of it. Remember the example we said, why are we selling our carpet for double what we paid for it when we've owned the building for 7 years? So you're not paying back. We're not selling our carpet for more. So you're not paying tax on that carpet. Take the deduction at a high rate, pay back some of it at a lower rate at a future date, and save that spread. And oftentimes that spread is far more than what the fee would be to get a study done on a cost seg study. And that doesn't include time value of money, paying down debt, buying new properties, investing the money in the stock market, maybe Bitcoin. I mean, Bitcoin's taken off lately. So if you invested in Bitcoin, it's well worth it. But yeah, that answers that question. Can I cost seg if I remodel a building? Yes, you can cost seg. You can do the original building and the remodeling costs. Sometimes the remodeling costs don't warrant a cost seg study because you have actual costs now. And so depending on the size and scope, oftentimes your tax preparer can handle that, but definitely want to look at it. So if I already filed returns last year without a cost seg study, there's no point of the return now. Can I do a cost seg study now for the filing taxes? Yes, you can do a cost seg study now, even if you filed your 2022 return. You can still file in 2023, take the deductions on 2023's return, or you may be able to amend your 2022. Let's say last year in 2022, you had a huge tax bill and you were in a higher tax bracket. Sometimes it makes sense to amend that 2022 return versus pushing it forward to 2023 if maybe you had less income in 2023. But yes, you can still do a cost seg study. The savings you spread, saving the spread you mentioned regarding depreciation recapture sounds like it's only good if you personally own the property. I'm a passive investor in a syndication. How does cost seg help if it offsets the passive income? That's a great question. So if you're a passive investor into syndication, you may not be able to take full advantage of the depreciation. However, that depreciation that's on the books, you'll never have to pay taxes on your rental income, number one, until it's used up. Number two, if you ever sell an asset, so maybe you've got this depreciation from your syndication, you've got $200,000 sitting here in this depreciation bucket. Let's say I have a separate rental property and I sell it and I have a $200,000 capital gain. That now unlocks, that capital gain will unlock this $200,000 sitting here in this depreciation bucket, and I can now utilize that to offset the capital gain. So it doesn't hurt to have that depreciation on the books. You may not always be able to take full advantage of it in a syndication type event where you're a passive investor, but having it on the books does allow for some good tax planning if you were to sell an asset. I've even seen people pull out income from a retirement account and take advantage of it that way. There's a number of ways, but those are good questions. How much do cost segregation studies cost for a single family home? That's a great question. I should have mentioned that. So cost segregation studies, they're anywhere from about $2,800 for single family rentals all the way up to $50,000 for ski resorts. So now I know that's a wide price range, but typically you're going to save about 10x on your investment. So if we're charging $3,000 for a single family rental, you're hopefully going to save around 30 grand in taxes, but that's kind of where they start. Our average fee here at our company is about $6,000. Again, we've got a lot that are in the $3,000 range. We've got some that are in the $10,000, $20,000 range, but that kind of gives you an idea. And remember, we always do a free analysis. When we do our free analysis, we'll provide you a quote and say, hey, you're going to save X amount of dollars in taxes. Here's what our fee would be. And then you can decide with your tax preparer if it makes sense. If we buy $1 million condominium built in 2024, can a cost seg study pay for itself? If the study is done, is it possible to find 45L savings for the construction? So if you buy $1 million condominium, yes, the cost segregation study will far pay for itself by doing cost segregation, because your $1 million condominium, you're going to get $300,000 of deduction. If you're in a 30% tax bracket and you can take full advantage of that deduction, that's $100,000 tax savings. And on $1 million condominium, the study is probably going to cost you $3,500. So you pay $3,500, you save $100,000 in taxes. Now you won't be eligible for the 45L because you didn't have basis in the building. When it sounds to me like you bought the building, you said if we buy $1 million building, no. If you built the $1 million condominium, then yes, you may be eligible for the 45L, but because you bought it, it's probably the developer who's eligible for the 45L. Next question is this only for commercial buildings? No, absolutely not. So single family rental homes are eligible for cost segregation. Everything from, we've done basement apartments. So maybe you live in the upstairs, but you've got a basement apartment. Those are eligible. Any revenue generating property is eligible for cost segregation. Next question is, do you have to be considered a real estate professional to take advantage of cost seg? No, you don't have to be a real estate professional, but you do have to have passive income to fully take advantage of it. So if you have, again, I'll use the example of me and my wife. Me and my wife, let's say between the two of us, we make $200,000 of income. Our rental property makes $20,000 of income. I do a cost seg study on it. I create an $80,000 deduction. I can't use this $80,000 deduction to offset me and my wife's $200,000 of active income. I'm going to have to pay taxes on that. but I can use this 80,000 to offset that 20,000 of rental income, which is going to give me a $60,000 leftover that I can carry forward until it's used up. There is a bit of a loophole. I hate to use the word loophole because it's not really a loophole. It's actually what the tax code says. But if you're investing in short-term rentals like Airbnb type properties, then no, you don't have to be a real estate professional. And when you do the cost seg study, there may be a chance to use these deductions to offset your active income. So as long as the average stay is less than 7 days and you materially participate in the management of your short-term rental, now that gets treated more like you're running a hotel or a bed and breakfast type business versus having real estate. And so when you're managing that business, that's an active deduction. And now that can be used to offset your active income. So there are some ways around that if you don't find yourself as a real estate professional. When you do a new build or major renovation, there is labor and material component. Is the example of 5-year corporate, I'm assuming the amount of depreciation based on the total cost, labor and material. Yes, that's correct. That all goes into that. It's not just the cost of the carpet. Is it easier or more beneficial to do a cost seg with a short-term rental? It's not easier or more beneficial. It just depends on your specific tax situation, but it doesn't have to be a short-term rental. It could be a long-term rental. It could be an office building. It depends on your individual tax situation on whether or not it's going to be beneficial. And that, again, is why we always run that benefit analysis. Is it possible to do a cost seg when I have a rental property that I want to 1031 exchange at loss so I can take the deduction and use it to reinvest in the other property? Yes, you can do a cost seg study and then do a 1031 exchange. However, just keep in mind when you do a cost seg study, it lowers your depreciable basis and is going to make that loss even greater, which may help save you some tax dollars. So again, talk to your CPA on that. But yes, you can do a cost seg study and a 1031. In some instances, it makes more sense to do the cost seg study after you've done the 1031, do the cost seg study on the new property. But in some instances, it absolutely makes sense to do it before. So it just depends on your specific tax situation. Let's see. We've got, can you explain how a cost seg amounts are reduced based on the lower basis of my property compared to what I paid for it? I bought it using a 1031 exchange, paying $1.1 million in cash, but the basis I now have is $360,000. Okay, so that's actually ties into that last question. So when you do a 1031 exchange, even though you buy $1 million building, what you're doing is you're deferring. So you're selling a building that you've already taken depreciation on, and you're buying a new building. When you buy that new building, you have to take into account the depreciation you took on the old building, because you're kicking the can down the road. So the IRS isn't going to let you kick the can and then start over. So that's why your basis in the new building is lower than what you paid for it, because you already took depreciation on your relinquished building, and now you have to account for that in the new building. That's a great question. Can you do a cost seg study in opportunity zone? Absolutely. We do those all the time. That's a double whammy. That's a home run. You can absolutely do cost seg on opportunity zone properties. If I purchased a property in 2017, lived in it for a few years, and turned it into a rental in 2020, does it qualify for bonus? If you bought it in May of 2017, then no, it doesn't qualify for bonus. Had you bought it in October of 2017, then yes, it would have qualified. But you bought it prior to the bonus rules taking effect, therefore you don't get bonus once it becomes a rental. If an individual purchased real estate, placed it in service as a long-term rental in 2023 and is converted to a short-term rental in 2024, is it possible to do a cost seg? Yes. So we could do the cost seg study in 2024 and take advantage of the short-term rental loophole. The cost seg numbers are going to be the same. It's whether or not you can utilize the deduction, and you may be able to utilize it now that it's a short-term rental versus a long-term rental. So again, the numbers are going to be the same. It's just whether or not you can use the cost seg study. If you don't place a property in service until a certain date, do you use the original purchase price or the current appraisal? It's always the original purchase price. So you get to start depreciating it based on the in-service date. Now, in-service, according to the IRS, is the property available for its intended use or purpose. But the IRS does not allow you to take depreciation greater than what you've paid for an asset. So if you buy a property for 200,000 and sit on it for 3 years and you don't put it into service for 3 years, and by the time you put it into service, it's gone up in value, you still only get to take the $200,000 of depreciation. That's your starting point. You don't get to depreciate it at the current value. Cost seg study on a purchase price of 600,000. I would have to, or the cost of a study on a purchase price of 600,000. We would have to look at the property. It's based on the size and scope of work, not necessarily the dollar amount. And so I got to figure out square footage, the acreage of the lot, the type of asset, how long the asset's been in service. Those are some of the factors that go into our pricing, but definitely go to that site there, the Protect Wealth /cost seg, put in your information and we'll get an analysis over to you and give you a price. If you bought an old house for 160 and then spent 50,000 on repairs before putting it into service, is it worth a cost seg? That would put your basis at around 210. Definitely worth looking at. Depending on what the land is valued at, it may or may not be worth it, but we'd be happy to run an analysis and give you an idea. Any special cost seg interaction on 1031 exchanges for commercial building? No. I would consult with your tax preparer before you do the 1031 exchange to see if it makes sense to do the cost seg study before or after. It depends on your situation. In some cases, it makes sense to do it before. In some cases, it makes sense to do the cost seg after the exchange and do it on the second property. Can you do a cost seg on the fence of your personal home? No, you can't cost seg anything on your personal home. Has to be a revenue generating property. If I use a 1031 exchange when I sell an asset, how does the bonus depreciation or the cost seg affect the process? That goes back to that question. Well, you'll have a reduction in basis. Oh, excuse me. I don't know if the question exactly. If you're maybe they're talking about when you sell an asset that you've done a cost seg study on. When you 1031 exchange, nothing happens. When you 1031 exchange, you're deferring your capital gains tax, you're deferring your depreciation recapture, and you don't pay those taxes until you sell that asset outright. So 1031 exchanges are a great combination with a cost seg study. A lot of investors will buy a property, do a cost seg study, 1031 exchange into a larger property, cost seg study, 1031 exchange into a larger property, cost seg study. Eventually, unfortunately, we all die, and then our estate will get a step up in basis and nobody pays tax. So they work well hand in hand. In a syndication, how does the depreciation recapture work? It all gets allocated through the K1s, and so there will be a tax on the K1s. And so that's just something to be aware of. Talk to the partners on that to see how that's going to work. But typically that gets spread out through the K1s. Can you guarantee the savings you provide once we submit it to our accountant? So we can't guarantee the savings because we don't know your tax situation. So we'll run our benefit analysis, and then we always suggest that you put that in front of your CPA because we don't do the return here. So we can't guarantee our savings, but we'll give you a benefit analysis up front, have your tax preparer put that into your return, make sure that it generates a savings, and then engage us to do the study, and we'll get you exact numbers after that. RV parks, question mark. Yes, RV parks are great. They're great candidates because when you buy an RV park, you're basically buying land improvements. And so RV parks can generate high yields when it comes to cost segregation. Cost seg for oil and gas assets, no. Only real property. In this case, it would be real estate. If you don't have W-2 income, only have Social Security, pension, and interest, can bonus depreciation be taken? It doesn't matter what the type of income is, whether it comes from W-2 or Social Security. It depends on whether or not you're an active participant in your real estate or if those deductions. So it depends on whether or not your income is active or passive. And so there's a lot of factors that go into that. So I can't answer that, but talk to your tax preparer. If you've got passive deductions and passive income, then yes, you can utilize cost seg. If you've got active deductions and active income, then you can utilize it. So that's something you'd want to talk to your tax preparer about. Sounds like cost seg before the 1031 sale of a commercial building might increase your chance of receiving boot on the transaction. That is correct in some instances, absolutely, because it's going to lower your basis, which means you're going to have a higher capital gains tax, and it could in turn result in a higher boot on the transaction. So again, talk to your tax preparer. Only in rare instances does it make sense to do cost segregation prior to doing the 1031 exchange. We typically would recommend doing it after, as long as you're investing in a larger property. When I say larger, I mean higher dollar amount, higher basis. What if you have a short-term and a long-term rental in the same building? Great question. I've seen CPAs handle that differently. Sometimes CPAs will put it as two different assets, one at 39 years, one at 27 and a half. Sometimes I've seen them take it on square footage and say, hey, the square footage on the short-term rental is more than the long-term rental, so we're just going to classify everything there. But again, talk to your tax preparer on that. Cost seg study on your personal home converted to a rental, absolutely, but keep in mind that the cost seg study will be based on your original purchase price when you first bought it, not what the property is valued at when you convert it to a rental. Do you have to do this every year? No, you only have to do the cost seg study once. We create that revised depreciation schedule. Your CPA uploads that, and you're good to go from there. Bonus depreciation can only be taken advantage of on the rental property was in the possession starting in 2017. Actually, there was bonus depreciation prior to 2017, but it had to be on new construction, because remember that one thing I talked about where I said, I used the bulldozer example. I said if it's a used bulldozer, it wasn't eligible for bonus. Same thing on rental properties. If you built a brand new building and owned it in 2016, you were eligible for bonus depreciation. But if you bought a building in 2016, you were not eligible. So hopefully that answers that question. I think there's a few here in the chat. Let's see. Oh yeah, it looks like Kendall, you put in some information in the chat there with some links. Kendall, I don't know. We'll get you guys a copy of the slides. I imagine you'll send them out, or I don't know how that works. So
yeah,
okay.
usually we send the recording next day. If you got like a link to the slides, I'll just throw that in there as well. That way they
Okay.
give you the detailed. A couple were asking for the detailed numbers, kind of hard to
Okay.
see, so that would be helpful.
Yeah, we'll make sure to get you guys a copy of the slides. But thank you guys. We were able to answer a bunch of questions.
Yeah.
I don't see any other questions. So with that, we'll go ahead and then wrap it up. I'll turn it over to you, Kendall.
No, that was awesome, Erik. Thank you so much. I learned a ton on that. Super helpful. I know a lot of our students will love this because they're real estate investors. Gosh, I just love this strategy. Hopefully, a lot of you learned a ton and are going to take advantage of this. And we really do love Erik and his team over there at Cost Seg Authority. They're really good guys. We've known them for years. They will take care of you. And it's amazing to see the detailed studies they give you. So take advantage of that. Sign up. We're happy to help you. Erik, thank you so much for the time tonight. I appreciate it very much.
No, absolutely. Thanks, Kendall. You have a great week. Thank you, guys.
Everybody, thanks so much for coming. Have a great night.
Care.
We'll see you soon.
All right, bye-bye.
Good night.